You know, everybody wants to be wealthy. Do you really want to be wealthy? Or do you just want that illusion of wealth as we see different markets go up while the value of the dollar goes down? This is called phantom wealth, and that's what we're going to talk about today because it's critical that you understand this and you understand the difference. So first I'm going to go to the millennials, which are those that were born after 1982 according to the Federal Reserve. And they are defining wealth as it includes real estate, consumer durable goods, corporate equities, mutual fund shares, defined benefit pension entitlements, defined contribution, pension entitlements, and private business assets. Where are the hard movable assets? Why isn't sound money part of that? We need to change that. But take a look. Millennial wealth in the U.S. has nearly quadrupled since 2019. What happened in 2020? A ton of printing. In fact, I can use both of these hands at once. A ton of printing, which pushed those paper assets up, and those assets that were targeted for reflation. Let's hope that those millennials aren't trying to buy their first house. But St. Louis Fed reported between 2019 and 2022, home prices jumped 44%. And that is largely driven by real estate gains. So those gains since 2019, largely driven by real estate gains. The median wealth of these younger people more than quadrupled during this 3-year period. Now, this is actually important to understand because if you see you open up your statement and it looks like something has gone up, your retirement statement or your stock portfolio, what have you, then in theory anyway, you feel richer and therefore you are more likely to take on more debt and spend more money. But there's a shift that's happening and it's really pretty interesting. But even as households became wealthier, inflation and instability have left more people in the bucket of so-called Henrys, which are high earners, not rich yet. And the Henry phenomenon isn't limited to millennials or Gen Z. It's harder for every generation to feel financially comfortable when the management of so much risk, we're coming back to that, related to employment, healthcare, retirement, pensions, insurance, and other components of economic well-being has been shifted to individuals during a period of rapidly rising prices. And the reality is this shift from the few, from the corporations, to the many, to the public that really don't understand how these markets work, well, that's been happening actually since the early 70s when Nixon took us off the gold standard. And then the central banks were in charge of regulating the rate and speed of inflation and therefore helping you feel more wealthy as the devaluation of the currency added to gains, paper gains at any rate. So the question that you have to constantly be asking yourself, and this is a question that I ask myself all the time, has enough risk been transferred from the few to the public so that during this next crisis, it will be too expensive to bail out? That's what everybody needs to know. So let's take a look at the probably more truth, median household income by state. And remember, I have the links to all of this work below. Make sure, by the way, that you give us a like, subscribe, and share. It's so important. But Maryland has the highest income, average income, median income, I should say, at $87,000 a year, which might sound like a lot to you. Mississippi has the lowest income of $46,500 a year. Interesting enough. Well, how about the cost of living? Because it doesn't matter how many of these things you have. It matters what you can do with it. Period. End of discussion. I have a $10 trillion Zimbabwe note and I can't buy eggs with it or anything else. Eggs are another story for another day. But let's also look at the cost of living for a family of 4 in each state. Maryland, with the highest income earners, their cost of living, even though the median income is $87,000, their cost of living is targeted at $99,000. That's a pretty good shortfall. And Mississippi, that has the lowest income at $46,500, their cost of living is $88,000, almost double what the median wage is. Do you see the problem? And so what people do in order to sustain their current standard of living is they take on debt, which also creates new money inside of the system. The total average debt by generation going back 2020, 2021, 22, 23, and then the last one is anticipated in 2030. The fiat money bridge between that difference of income and expenses is debt, and you can see that debt continues to go up, though the millennials have the fastest rate of debt increase. Isn't that interesting? No wonder they feel poor. And at the same time, we're looking at economic growth that is slowing and slowing. And so what does that mean? Fewer job opportunities? And if you're afraid of not being able to easily get another job, then you accept lower wages. And how does that help you? The U.S. gross domestic product, and remember, inflation is in those numbers. They don't want you to realize that. But our inflation is running at roughly, if you believe their numbers, which I don't, but if you do, isn't it interesting that the growth is roughly the same amount as inflation? There's no real growth. And there isn't going to be real growth, but there is going to be a whole lot more inflation. And so how is this going to impact people's standard of living? If you're wealthy, all of this inflation that we've been experiencing doesn't really impact you. But if you're living paycheck to paycheck, which a lot of people making up to $250,000 a year are doing, we got a real problem. Because what does that do to the default rates? And we're seeing signs of this distress all over the place. Because in reality, a rising gold price is a signal of distress. And when you have the dollar and gold rising together, wait a minute. Let's think about that. Because this is sound money. This is government fiat money. They're both money. They're the flip side of the coin. So in theory, what you expect to see is if the dollar goes up, it's really going up against those trading partners or other currencies, other fiat currencies. But you would see the dollar go up and the spot gold market go down and vice versa. And if you're looking just on a day-to-day basis, it's mostly what you're seeing, mostly. The inverse relationship between the two always reasserts itself. And he is the precious metals analyst, the chief one at HSBC. Is that true? Now, if you just take his word for it, that's one thing. But let's look at the data. And we're even talking about the manipulated spot market. And this goes from 99 to 131.25. And the red is spot gold. But can you see all the way back here? Oops, I didn't grab my little thingy. Here we go. Can you see over here where, yep, it was a mirror image of each other? This is when I first came into the gold market, when this shift started to take place, because I knew, since I've studied currency life cycles since 1987, I knew this was the end of this systems experiment. I can never tell you when, because goodness gracious, they can come up with all sorts of things to keep things looking a certain way. However, it is the public's experience, and when they start to see this rapid inflation, then they start to lose confidence. And when all confidence is gone, there you go. But I do want you to seriously look at the spot US dollar. This is a contract, right? And where they want you to think that, oh, that always reasserts itself. Well, I don't think this man knows history. I don't think this man understands currency life cycles. And frankly, that's what I find from most people. And we can see these cup formations that I've talked about. And once it broke out, you can also see how they manipulated the price down. But it really doesn't matter. Once that breakout occurs, it occurs. Accept it and understand that that is a pattern shift that bears watching and playing into, moving into. This is what we're talking about as sound money, because you'll see these kind of technicals on all sorts of things, but what do we know? We know that the stock markets, the bond markets, the real estate markets are severely overvalued. Can they go up more? Sure. I think we are definitely in a melt-up phase. But with the new administration, there's going to be a lot of volatility in these markets. So what I really say is get to safety. What is the safest thing you can do? Sound money. And we have a strategy that's built in layers. Every single person on this planet needs a foundation in sound money, because that's what's going to protect you from all of this. And also, we're going to see as time goes by who's going to survive this mess. And guess what? If you're holding your purchasing power intact, you're going to be able to take advantage of what still yet lies in our future. But don't be fooled by the hype, because they don't want you to look at physical gold and physical silver. Once you own it, you hold it, you own it outright. No counterparty risk. All this other stuff, completely counterparty risk. So you can look short term and see one thing, but frankly, over time and history, you can see more of the truth. Now, is this really reflecting even above 2,800? Is that reflecting gold's true value? No, it does not reflect gold's true fundamental value. That is a trading market. And hey, if you're a trader, rock and roll hoochie coo. I can't tell you what to do. But if you are a strategic investor like I am, you get into position. You do not get blinded by those numbers, because you understand that this is designed to lose value, and the markets going up are designed to sucker you in. And if all you're doing is gold ETFs, you're still suckered in. It has to be the physical markets, period, end of discussion, that you pull outside of the system, and then you let the markets do what they're going to do. What if I'm right? What if I'm wrong? If you can do something where it doesn't matter whether you're right or wrong, would you not do that? Because I do all day long. If I can do what doesn't matter if I'm right or wrong, even if it costs me a little premium, as long as I'm clear on what the true value of this asset or instrument is going to do, because I can't give you a lot of guarantees, but I can guarantee you that I will show up and do the work, because that's my biggest commitment to you. And I can also guarantee you that at some point, all assets, all instruments move to their fundamental value, which in terms of fiat money, and I don't care what currency it is anywhere in the world, That's zero. But for physical gold and physical silver, in terms of this garbage, which once you see that, you're not really going to want to convert it in unless you're going to execute part of the strategy, the truth will always prevail. And as further proof, just look at what you would have gotten had you been paid in sound money gold, even going back to 1913. You don't want to go that far? Go to 1971. And quite frankly, had you been paid in gold without a raise, you would be earning right now $710,553.06 at the current spot if you owned that, if you were paid the same amount of gold. And what if you were paid the same amount of silver? You'd be at 223.64.52. I rest my case. Now, make sure that you click that like button. Leave us a comment. We need to get the conversation going. Share, share, share. Make sure you subscribe. And also make sure you check out our most recent videos about the Japanization of the U.S. And actually, I'd even go so far as to say the world and what that really means for you. And I'm going to tell you this, and I know it. Look in the mirror and ask yourself, if not me, who? If not now, when? Join this community. Help us grow. Let's create that very quiet revolution and put sound money back in your hands. Take back your power. And until next we meet, I know that together we can make a positive difference really for the whole world. Please be safe out there. Bye-bye.